Okay, so my name's Dave Faulkner, and Neil Greenbaum, head of Advisor Solutions, is going to. I'm going to do the first two-thirds, and then he'll finish up and talk a little bit about Nestwell. I want to first talk about defining value by making advice the product, and to me, there is no greater opportunity right now for financial advisors than to talk about the spend in Plan Save Spend, decumulation. How do advisors decumulate or spend in order to receive the maximum value and achieve the goals that they have for their retirement and their family? So I'm going to break it into first, how do you determine what really matters to your clients? And then secondly, I'm going to talk about how to use life insurance to add even greater value. Then Neil's going to finish up and talk about the Nest Wealth Advantage and how to use our digital wealth platform for you and your clients. I want to handle all questions at the end. We'll just do it into a chat, and then we'll try and get as many answered as possible. Okay, so decumulation, what is it? If you look at Webster's, it's simply the disposal of something accumulated. And to a great extent, I agree with that, except in retirement planning. In retirement planning, if I was to draw a picture of what decumulation looks like, because a picture's worth 1,000 words, it would be the I think this is the Yukon something at Canada's Wonderland. This is decumulation planning, and it starts out nice and innocent with a discussion about estate, assets, or income. I mean, when decumulating, you need to optimize for a given age, either for the greatest estate, the greatest number of available assets or net worth, or the greatest amount of income. And the moment you start talking about that, it's all good and it's really flat, like the beginning of this roller coaster, and then boom, they drop health and the target age. You know, most decumulation looks at life expectancy, 85 or 90. But then the client immediately starts to talk about, well, what if I die too soon? What if this happens? What if that happens? What if my health changes? So things become more complicated. And once you get past health and target age, then out of nowhere comes loss aversion and attitudes or opinions around when should I start CPP and OAS. Because solving the decumulation question for the largest estate will not give you access to the most money. And so you can never have it all. And the largest estate value at age 85 may not be the largest estate at age 75, 80, or 90. So we have all these problems. And then using CPP and OAS as an asset in retirement, because it is, and then talking about when to start that opens up a whole new can of worms. And so it's very important before you make recommendations that the client understands what they're giving up for whatever recommendation or time frame that you're looking to solve for. So to do this, I'm going to be using Razor Plan. Now, this is financial planning software program. It's been around since about 2014. We pioneered algorithms to answer all of your clients' most common questions. So, and we're taking that to another level to answer the question about decumulation. So, decumulation goals. How do you help clients draw down assets to best accomplish what matters most to them? And that's what's important. I see articles all the time, and it's always about estate value. These articles all talk about decumulation and the largest estate or paying the minimum tax. But I've had many clients that want a decumulation strategy that gives them the greatest amount of income or an ability to give money away to their children before they die. And so you need to determine what matters most to your clients. So I'm going to use Walter and Maggie. This is my couple. They're both age 60. They're relatively healthy. They have $1 million in RSPs and $1 million in TFSAs and non-registered. They're going to draw CPPOAS as soon as possible. They're like average Canadians. You know, I paid for it. I don't trust the government. I'm not going to wait. What if I die? So 60 and 65 are the draw dates. 4% rate of return, 2.5% inflation. And the planning horizon is age 95. Now, 95 isn't necessarily what we're going to solve the decumulation puzzle for. So let's just look at first a common strategy. And they came to us with this in mind. When they retire, they're going to draw from registered first and spend all of that because they read articles that that's the way to do it. Then they're going to spend non-reg TFSA. They're going to start CPP at 60 and OAS at 65. And so we can take a look at what their assets look like. And so their net worth starts out at 1.5, grows to about 1.8, and then slowly declines to be 1.5 again at the planning horizon or age 95. We can also see no major clawbacks of old age security. This is a little bit of the age credit, but nothing serious. No high tax rates. It all looks pretty good. Risk management. Here's the tax bill on the RSPs. RSPs are gone, a little bit of unrealized capital gains, but we've eliminated all the tax. And we take a look at our original algorithm, the retirement options. So their goal is $78,000 a year. They can spend as much as 91 if they want to spend their last dollar at age 95. They're already retired, so there's no retirement shift. Minimum rate of return that is required is 2.25. They need $1.6 million. So it all looks pretty good. We got a little buffer room. Everything looks really good. Now, but what if they draw non-registered first? They just flip it around. And so we can do that. We can look at the financial assets. The net worth starts low, then grows, and at some point here, it surpasses, the estate worth surpasses the draw from RSP first. Again, income tax, no big deal. We're leaving the RSPs till the end, still just age credit clawback. We now have a tax bill, however, yet ultimately towards the end, even though there's a $200,000-300,000 tax bill, they still have a greater net worth. And the retirement options are actually better. They could spend $95,000 as a maximum instead of $95,000 before. But that's a ton of work. You can't be, manually doing what if strategies and things like that. That's why we developed the 4 retirement options. So it eliminated all the what if questions. So what is the right decumulation strategy? And the answer is simply this. The right decumulation strategy is the one the client agrees to do. But you need to advise them. And so we created an algorithm that we call wealth at risk or WAR. Now, this is like tug of war because decumulation planning is a tug of war. CPP, OAS, registered, non-registered, all these things are tugging at the client and their attitudes and loss aversion and all kinds of problems come in. So it's like a tug of war. So this is wealth at risk. This is WAR. When you go click on this button up here, so previously I was on the analysis page. Now I'm on the wealth at risk page. And so it immediately calculates 4 strategies. The first thing it does is it calculates the worst strategy. Sorry? I heard that. So it calculates the worst strategy and it calculates the best strategy, and it displays the wealth at risk. So if your client did everything wrong, they did it the worst way possible to draw down on their assets, they would end up with an estate at age 85, because that's what we're solving for, also showing up here. They would end up with an estate of 1.6 million. But if they get it 99% right, according to the algorithm we've created, they would have close to $2.2 million. So the wealth at risk is over $500,000. And if then we look at non-registered first, which is not much better than the worst strategy, and then we look at registered first, which is better than non-registered, but nowhere near as good as a blending of all these different assets. Rather than saying one or the other, it's a fraction. Now that's a state, but what about net worth? So if I'm solving for the greatest amount of flexibility, the largest pile of cash at age 65 or age 85, sorry, forget about the estate. Our wealth at risk is $680,000. Get it wrong, 1.8 million. Get it right, 2.5. Non-registered now is closer to the best strategy, but not totally. And RSP is closer to the worst strategy. So what is it that the client wants? Is it control over cash, a big balance sheet, or is it knowing their children are going to have the largest amount of money when they're done using it? But then you've got to ask the question about what are we solving for? Because the allocation between registered, non-registered, client, spouse, TFSA, CPP, and all of that, the best allocation is determined by the age you are targeting, nothing else. And you can only target a single age. So this is what it looks like at age 80. But if I change to 85, you can see that the registered, non-registered strategies are getting a little worse, and the delta between the worst strategy and the best strategy is improving, and to the point where if I'm solving for 90, I can find $750,000. But does the client want to do that? And then same thing with net worth. Start at age 80, we have a delta of 500,000. Go to age 85 and it's almost 7, and nearly $1 million difference by age 90 to get it right versus getting it wrong, and certainly close to $500,000 if you just try to do non-registered or registered or that kind of thing. And so the algorithm, it's doing tens of thousands of calculations to find the best mix between all these assets and when you should draw CPP and all of that. But the story doesn't end there, because even if the client gives you an age and they say, yeah, we want to target age 80 or 85, and it's about our estate and our kids because we love them, and we realize, it's not about the cash, it's about the after-tax cash. Oh, great. But here's your problem. Here I have solved or optimized for estate value at age 85, and we can see clearly here that the algorithm has produced a drawdown strategy that is $1 million better, or 500,000-600,000 better than any other strategy. But the problem is this. Here's loss aversion. What if I die at 69? If they die at 69, their estate is actually worth 200,000 less than had they just drawn registered first. And so this loss aversion comes in, and it's, do we really want to take the risk of losing $200,000? And the other problem is, having solved for estate or optimized for estate, if we look at net worth, the best strategy, So let me go back here. The best strategy for your estate value is the worst strategy for access to cash. You actually have the absolute worst strategy for asset value or net worth until age 75. And then it's only better than a registered first strategy, and it takes till age 85 till the capital catches up, which is the optimization year. So these are the questions, these are the discussions. You know, good planning is about choices. And if your client doesn't fully understand these choices, you can run into problems and dissatisfaction and a whole lot of things with clients. So it's so important you talk about these things. And the same thing happens if I solve for capital, net worth. Here again, we've optimized for net worth at age 85. I'm displaying the results every year for net worth, and clearly the strategy is the best. However, it's not the best until age 80. Non-reg first is a better strategy up to age 80. And if I flip to display the estate, again, the strategy for net worth and access to capital is the worst strategy for many years for the estate prior to the optimization age. And so this is the kind of discussions that I like to have with clients, and it eliminates all kinds of problems, and clients appreciate the ability to be able to make informed decisions. And once we get past all of that, at some point, I have to have the conversation about CPP and OAS biases, because I've had many clients. I have a really good friend. They're worth multiple millions of dollars, retires at age 60, and immediately starts his CPP. And I say, why? He goes, because, well, it's mine and the government may tank and I won't get it or they'll tax it. I said, no, you won't. Like, why are you doing this? It's a hedge. You should leave it till age 70. It's something you can never outlive if you lose all your money or anything else. But it didn't matter. He was taking that money at age 60 and I couldn't change his mind. Anyways, so I got to have this conversation. You have to have this conversation with clients about CPP and OAS. So here's the situation. I have looked at optimization for estate at age 90 in this example, and we have a delta of 750,000 from worst to best. And non-reg RSP alone are not much better than the worst strategy. But leaving CPP over here to age 70 produces a lot of value. And this is how I know, because down here, I can disable CPP for the client and spouse and disable the algorithm from moving the start age for OAS. And we do this for people who may have a shortened life expectancy due to health. And so if I turn off that, we now see that our best strategy has a delta of only $277,000 and 1.9 million estate value. So let's go back. Okay, if I go back, almost 2.5 versus 1.9, $600,000 of estate value lost because they want to take CPP OAS as soon as possible. And this, like optimization of government benefits, is a huge opportunity for advisors to show value. And again, we can take a look at that and we can see it every year, how it looks as we go from excluding CPP to including CPP. Okay, so now I want to talk about some advice and how to integrate life insurance when you know that family is what matters most. So I'm a big family guy. I got 3 sons, 3 beautiful daughter-in-laws, and 6 amazing grandchildren. And I would do anything for my family. And so I'm definitely a optimizer for estate value. But how can life insurance make it that much better? And so life insurance has a place in decumulation planning, and it simply covers off this loss aversion. And so let's go back to Walter and Maggie. We're now going to maximize estate to age 80. No more moving around. They chose age 80. So we're a little conservative. We're going to let CPP and OAS benefits also be optimized. And I've added a $500,000 joint last T100 annual premium 7150. It's actually, I went over and I just did a quick quote. Believe it's an Industrial Alliance T100. And so I'm going to enter that. I've created a new scenario in the case called add life insurance, and I'm going to just add a permanent life insurance policy. Now, when you add a policy into Razor Plan, you can add just the death benefit. You can manually add the values like I've done here, 500,000 in the premium. You can also run a simulation. We have our own set of mortality tables, so it's just a quick answer. Or you can import from an exported Excel spreadsheet from most of the software programs out there. So if you want whole life or a hybrid product or certain things around cash values, you can simply do an import. So when I'm done, it just saves it and it puts it into the system. So with the life insurance now added, I've run the war algorithm another time. And what's interesting to note is that the previous algorithm without the life insurance, the worst case scenario was $1.55 million. And the best was 1.9. Now the worst case scenario is 1.8, which is equal to or greater than the three scenarios like RSP, non-reg, or anything else. And so the point is we've changed the entire dynamics of this analysis. And so what I've done is I've loaded the results for no insurance. Okay, so this is just, they were registered first and I ran it. And when I overlay the best allocation strategy for decumulation with that life insurance policy, we blow away everything else. It is from start to finish the absolute best estate value. And that's simply because the $500,000 worth of term insurance is ensuring all the potential loss of early death. And it's joint last, and the only way you ever end up with a less than optimal strategy is if both people die prior to the optimization age. And so life insurance just improves everything. And other things you can do with this is you can go to the strategies tab and it will show you all the different allocations, the non-registered, the RSP, CPP coming in, OAS coming in, and so on. And you can also look at the non-registered first priority strategy, the RSP priority strategy, and you can also look at the worst strategy. But what I like also is you can set it to 100%. So this is allocating as percentages all of the income that we'll be drawing as a percentage. And so we can see non-registered, registered, and how everything flows in. And you can also print details. So you can scroll down, you can export it to Excel, and this will give you all of the details. And the other thing that we've added in the overview side, you click on view more, here is your action plan. So this is what Walter needs to do this year. You know, defer CPP, defer OAS, draw this much from a RIF, draw this much from non-registered, and so on. Here is the spouse allocation, and we can also do both, and this can be exported as well. So at this time, Neil, I hope you're there.
I am.
Okay, so since I'm already sharing the screen, if you just want, I'll just advance
Sure, that's
when
fine.
you ask me to.
All right, beautiful. Okay, so listen, I got to commend my colleague, Dave, because first of all, he's a math genius, and I just am so impressed with what he's shown you today. But the second thing I'm impressed is he actually kept on time, which is a rare thing for Dave. So good on you, buddy. I appreciate that. All right, now let's go to the first slide. I'm gonna suspend, a whole blurb about me and my background. I think I'm just gonna say, listen, I'm the head of advisor solutions at Nest Wealth. I've been here for almost 4 years. The reason why I moved was because, to me, I saw the writing on the wall. Much like Mike sort of, saw some of the struggles that advisors have, I saw those struggles plus all the struggles that asset managers were having, and just the whole mutual fund industry. That's where a lot of my experience was laid. And so, I just wanted to be on this new way of doing things, this, embracing the technology, embracing the change, and doing something that's different. And Nest Wealth, to me, was the perfect vehicle for me to do that. So let me help you understand a little bit about who Nest Wealth is. Let me tell you some of what I think the benefits are, and I'll go over some of the fees. Listen, this is more of an infomercial, in the sense that I just really want to get some key points across. Obviously, at the end of this, I'm more than happy to go in depth with anybody that wants to go, look under the hood and go deep, and really, go more and understand. So first of all, you can see the first point: privately owned wealth tech company. We were, or are, the first digital SaaS-based wealth platform in Canada. And listen, I think all of you know that a lot of these digital wealth platforms started out very much as, B2C plays. So these were digital platforms that tried to attract direct clients. And we realized very early on in our evolution that was not the right path. That we really didn't want to play in that space. The space we wanted to play in was working with advisors and working with firms. And so we made a strategic shift in our evolution, and I think that has done wonders for us. Not only did we produce a phenomenal tech stack that is powerful, that is being used in all different channels, but we have a lot of advisors, again, that have really been very successful using the technology as well. The other thing we did is we didn't just build sort of Nest Wealth Plus, which is an investment platform for advisors, but we also added a digital group RSP and obviously Razor. So I think Dave didn't talk much about this, but Dave saw the same sort of value and realization I think we all have had. And we really wanted to include a financial planning software as part of our toolkit for advisors. And so I'll talk more on that, but just phenomenal. And I think the other important thing here is that besides partnering with advisors, we really value independence. We much like Mike want to take away the struggles, unshackle the advisor, and really give them sit on the same table or the same side of the table as their clients. And you know what, we're independent. We're comprised of industry veterans, and we want to earn your business every day. So we don't expect it. We want to earn it. We want to work for it. And we're pretty confident we can deliver what advisors are looking for. So let's move to the next point: professional portfolio managers specializing in low-cost custom ETF portfolios. So I guess what I want you to understand is our PM shop is in-house. We don't outsource our PM. We have our own portfolio managers. I know, a lot of you heard from some PMs yesterday where you can utilize them. We have our own in-house portfolio management team. And we obviously, understand the power of the partnership with advisors. One thing that we've done that's very unique is we have capped our management fees. I don't believe there is another advisor, probably in North America, maybe the world, that caps their own fees. And that's so we don't cap the advisor referral fee, we cap our own management fees. And that's a huge differentiator. And the reality is we want not just small, medium-sized clients to benefit, we want all clients to benefit, even those high net worth clients who want to take advantage of a capped structure. So that's important. As I mentioned, we're independent. We have no competing distribution channels in terms of IROC, MFDA, MGAs. We have no channels that take our focus off what we're trying to do. We have no proprietary products, so our portfolios of ETFs that we use are not proprietary. We don't sell our own stuff to make an extra buck. We're not biased in any way, shape, or form. And we have no conflicting business interests or arrangements. So, we can be really laser focused on providing best-in-class technology and tools for the advisor. And that's what we're doing. Technology built in-house. Again, that's another important thing to understand. We have built a proven tech stack that a variety of firms are using, and you can see those, right? So our technology is white labeled and being used at National Bank, and we're actually signed a deal recently where we're rebuilding the entire custodian platform for NBIN. We have an IROC dealer, Align Capital. We have MD at Scotia, so we're also in Scotiabank. We have an MFDA dealer with IPC. We have MGAs that use our software. We have portfolio management firms like Forstrong who use our technology, and we have over 500 advisors that use our technology. So, we really are able to provide this reliable, consistent, evolving, sort of platform to better the experience for the advisor and their clients. And we really do that a lot by taking what the advisor wants. So the advisor is an integral part in the development of our platform, all of our platforms. So that's important. And then lastly, it says help advisors realize the value of their advice and take back control of their time to build better relationships with their clients and grow their business. And that's really what we have. We have a fully integrated, toolkit all under one roof where we can help advisors be their best, focus on the right activities at the right time, remove a lot of the, stuff that Mike talked about in terms of the pains and the challenges, and bring you a platform that can really deliver that. So let's go to the next slide. Okay, so digital wealth manager for advisors and their clients. So what is Nest Wealth Plus? Again, yesterday we heard from a whole slew of portfolio managers that offer referral arrangements. And I just want you to understand that we are very similar. We have portfolio managers. We're licensed very much in the same way as those PM shops that are available to all advisors in a referral relationship. We do all the compliance. We act as a fiduciary. We have all the knowledge and skills similar to again, those PM shops. The only difference is we use ETFs to build our portfolios instead of individual stocks. And we operate in an extremely low fee environment. But I just want you to understand that there's a lot of similarities in terms of the way we're structured in terms of being a PM or portfolio manager. The other thing that I think is important to understand is that, if some of you on the call today may be life license only, maybe you're not part of the MFDA or IROC. I just want you to understand that referral fees are something that are different than, than a mutual fund, in the sense that there's no DSC, there's no low load, there's no FYC. It's literally a referral fee that we pay on a monthly basis, similar to a trail, as long as the account is held on our platform, the Nest Wealth Plus investment platform. I think that's important. Obviously, we have a completely digital onboarding process. We've obviously keep iterating on this, so it's fluid. It's very simple. We have an 11-question KYC. It is just really simple to onboard a client. We give the advisor the ability to pre-populate information. Listen, we understand that advisors still want to do things for clients. And so we give the advisor the ability to do that for the clients so that they can make the experience that much better. And then we also have here advisor grid customization. Now, I know Mike talked a lot about the removal of a grid. But again, this is a customized grid that the advisor does. So this is not something that everyone has to adopt to. This is advisors being able to set their own customized referral fee grid so they can not only maximize the revenue they want to take, but also potentially give even their own clients, a reduced cost depending on the size of their AUM. So there's an ability to customize that. And then obviously, a phenomenal advisor dashboard. Many of the advisors I speak to, when they look at some of my competitors, they always say that our advisor dashboard is by far the best. And I think we've really worked hard to make that a reality. And then of course, we also have internal customer success teams and so on that really help us with again, making sure that the experience is great. And the other thing I would say that I maybe didn't put here is the fact that we're really skilled at transitioning businesses. So we've had a lot of advisors who basically were part of the MFDA or IROC, decided to make a change to their business model, and we were able to facilitate the move of their book of business to Nestwealth with ease, and do that very well. So we've become highly proficient at transitioning assets to our platform. And then I guess most importantly, we provide a platform for you and your clients to retire richer and gives you a consistent recurring revenue stream to grow and protect your business. And that's what we're doing. So one last thing I would say is we also heard from Don Campbell yesterday about securities regulation. And again, I would just say that I think we all understand, what part we play in a referral relationship, and clearly defining what that is. And again, we do the asset mix, we do the trading and rebalancing, the suitability KYC, the documentation and onboarding. And then we want the advisor to focus on what they do best, which is really the planning, the insurance, the tax, the client relationships, and just the quarterback for that holistic financial health of your clients. So next slide. So listen, what's in it for me and my clients? I mean, there's a lot of benefits to this. And again, Mike has touched on some of these, but we want to help advisors maximize their time and efficiency. I mean, and focus really on high value sort of actions. There's a lot of stuff that advisors do that may be repetitive, undifferentiated, really just simple tasks that in terms of filling out paperwork, doing KYC updates, rebalancing trades. I mean, there are certain tasks that are far better suited for technology. And I think we realize that and put that into our platform in terms of some of those things. But then there's certain things that an advisor has to be involved with. And, the human mind is a complex animal. We know that. And no computer can do the problem solving or the strategy or the interaction and the training and the creativity that is required in terms of the advice side, providing meaningful advice. And so that part, advisors always need to be the central part of that. So we're just trying to remove all those, again, activities and tasks that are really good for technology and that don't add a lot of value to the relationship, and get the advisor focused on the high value stuff, the stuff that clients want. We also help them take back control of their time, obviously, so they can grow and expand their business. I mean, we make the invitation and onboarding process seamless. It's literally a click of a button. They send an invitation. Your client gets through this digital experience, and there's no paperwork crossing anyone's desk. It's just fluid. And the other thing I love is that your clients can be anywhere in the world. They could be at the cottage. They could be traveling. They could be, at the golf course, wherever. I know in my case, I could be at the hockey rink, but the point is it doesn't matter where you are. It doesn't matter where your client is. They can really get through this process in a very easy and efficient way. And then listen, there's a world of opportunity for target markets. I have lots of advisors that use this as a small account strategy, and that's okay. Listen, this is not an all or none proposition. As you can see from the agenda of this conference, there is a part that sub-advisors will play, like the BCVs and the ones that are on this forum, this webinar, that you're going to send clients to, and that's okay. They maybe want that type of a white glove service, and they want that, a custom portfolio, and they want access in that sort of way. But for many others, they necessarily need that, and they would rather have a lower cost or a different experience. And so this could be a small account strategy. Other advisors do this so they can attract a new target market, maybe a younger families, younger professionals, and get them in their book of business. Other advisors use this, believe it or not, to go elephant hunting in terms of high net worth clients because of the cap. And obviously that helps too with retention. I mean, we've talked a lot about in these sessions, the fact that, the older baby boomers are sort of coming into retirement. Maybe there's a succession or a transfer of wealth reality. And oftentimes those kids of those clients go elsewhere. This type of a platform can help ensure that doesn't happen. And then I would say the other way advisors use us is a way to engage prospects. It's a way to maybe, expand your life-only clients and get them more on the wealth side. Or maybe it's just to get dormant clients who aren't doing anything active again. There are so many things. And the big kicker I love is that we're registered in all provinces. And that's huge because a lot of your, you may be registered for, 1 or 2 provinces, and that means you can only deal in those provinces. Because we, Nest Wealth, is the portfolio manager and registered in all provinces, that opens up the entire Canadian landscape. So if your client moves from your province to somewhere else, you don't lose that client. That client stays with you because, again, it's our registration. And then the other thing I would say is that there is a sort of momental shift that is happening in our industry. I don't have to tell you this. There's a massive move from mutual funds to ETFs that's taking place. And I would also say that I know a lot of you have conversations with clients even today about fees and the cost that they're paying. So if you look at those two things, as far as I'm concerned, this whole strategy of using our platform is as much about defense as it is about offense. Yes, we're going to give you some offense to be able to include ETFs into your, sort of conversations and adding that sort of maybe product to your toolkit, and obviously give you that offense in terms of talking about fees, but it's also defense, right? A lot of advisors are looking for that type of a solution so they can not only, attract new clients, but keep existing clients and at least have a platform available. So when those tough fee conversations come up, you have an answer. You have a tool in your toolkit that you can utilize for that. And I think the other thing is just, we want to help you consolidate your assets and build a fence around your client. Be that source of trust and really increase your digital footprint. So focus on the areas that you handle best and let us take care of everything else. Next slide. So I'm coming close. I just wanted to let you know that there are unintended consequences of digital. And what we've found at Nest Wealth is that 78% of people who contribute beyond their initial contribution. But more importantly, our clients typically have 2 times more within 6 months. And all I can tell you is that when you bring a client onto our platform, the experience that they have is so amazing. And that whole digital experience and that onboarding and just everything about it, oftentimes and the low fees, they actually see that difference. Like they can look into their accounts 24/7, they can see the difference and they go, holy cow, I'm doing so well. This is fantastic. And they end up consolidating their assets without even the advisor pushing a button. And that's the reality, is that if you really want to, consolidate and have your clients, bring assets over very easily without a ton of work, this is a great way to do that. Next slide. And here's our fee structure. So, we basically have a 35 basis points, 0.35% is our management fees. And again, that's capped at $150 a month, $1,800 per year. The advisor gets to choose their referral fee, could be 1%. They could build a customized grid. And then we have both passive and active. So our active is 4Strong. We use their ETF pools and we build our own custom ETF portfolios on the passive side. And that's it. So right on time. Look at that, Mike.